Good morning and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us. Today we're diving straight into what looks like a really critical institutional market intelligence briefing. Our mission, really, is crystal clear. We need to figure out exactly where the big money, the institutional capital, is actually flowing. Because, honestly, the tension out there, it feels really high, almost. Contradictory.
Yeah, contradictory is a good word. It's maybe more than just tension, though. It's what we're calling structural friction. Think about it like this. The market's trying to operate almost like a high-performance engine, but it's using two completely different kinds of fuel at the same time.
Okay, two fuels. Like what?
Well, on one hand, you've got this constant heavy drag. That's the macro caution, high interest rates, those rising yields we keep talking about, and now record U.S. household debt, that's weighing things down.
Right.
But then fighting against that, you've got this other fuel. It's like specialized high-octane stuff. These are the micro-catalysts, mostly coming from really selective, strong Q3 earnings from specific companies.
Okay. So that difference, that macro drag versus the micro thrust, that's really the key takeaway for you, for the listener. But hang on, if those broad market strategies like index funds are stuck because of that macro drag, doesn't that make chasing those individual company wins, that idiosyncratic alpha, I think you called it, isn't that way riskier? I mean, are we talking real alpha, or is it just, smart gambling dressed up by a few good earnings reports?
That's exactly the right question. And yes, the risk is higher, no doubt about it. But the opportunity, it's just too concentrated, too specific to ignore right now. It really means the old saying, a rising tide lifts all boats. That's just not happening now.
Okay.
But because some of these company stories, the execution stories, are so powerful, the potential reward for picking the right ones, it's still really high. You can't afford to be passive. Selection is absolutely crucial.
All right, let's dig into that macro drag first then, and the immediate technical picture. Looking at U.S. equity futures this morning, well, there's a definite softness there. Foundational weakness, maybe. The S&P 500 E-mini, it's showing a bit of a relief bounce, sure, up about, plus 233 points intraday. But we need to pause there, right? That little bounce, you have to see it in context. The bigger picture is still pretty bearish momentum. We've had a big drop over the last 5 days, down great at 0.61% 3. That's over 110 points gone. Does that steep decline mean shorts are getting more confident, or is it still just fear?
I think that strong negative move confirms the structural skepticism is really taking hold. It's overriding the day-to-day noise. The market seems to be pricing in conviction now, and that conviction, well, it's rooted in those constraints we mentioned. The jump in long-term bond yields, definitely. And crucially, that record-high U.S. household debt figure that just came out. When consumers are stretched that thin, it's just a massive headwind for big parts of the market, especially anything consumer-focused.
So technically speaking, where's the line in the sand? What level are the trading desks laser focused on today? Where does it technically break if that macro fear really grabs hold?
The immediate focus tactically is definitely on the S&P 500 E-mini first support level. That's sitting at 6,706.17. Now, if we fail to hold that level, it wouldn't just be a small dip. It would likely trigger a cascade of stop losses.
The domino effect.
Exactly. And that would technically confirm that the macro fears, specifically the anxiety around yields and debt, are really in the driver's seat.
Okay, but here's where it gets interesting, right? And points to your idea about specific alpha opportunities. While the S&P is looking soft, the tech-heavy NASDAQ 100 futures, they're actually trading noticeably higher, up over plus 133 points. How do we square that? This deep structural fear across the board, but then this pocket of strength isolated in tech.
That NASDAQ strength, that relative outperformance, that's the signal. It tells us capital is moving, but it's being incredibly selective. And what's really fascinating, if you look at the pre-market activity, is the extreme bifurcation. The split is huge.
Bifurcation.
Meaning you've got two totally different things happening at once. Yes, you see some crazy high-volume speculation in tiny stocks like BIYA up over 30% at a cent-on huge volume. Pure speculation, maybe.
Right, the lottery tickets.
Kind of. But right alongside that, you're seeing really significant high-quality moves in established, solid companies. So capital isn't just chasing any risk. It's hunting for validated risk stories, places where the company has actually proven it can navigate these macro headwinds.
Okay, validated moves. Let's talk about those. We saw some serious M&A activity boosting confidence. Bright House Financial, BHF, jumped over plus 26% on acquisition news. And Golden Entertainment, GDEN. Wow, up over a plus 40%.
Right.
That was an acquisition plus a sale-leaseback deal, wasn't it?
That's right.
So this is company leadership basically putting their money where their mouth is, signaling confidence in their own value.
Yeah, exactly. M&A like that always shows conviction. But the real aha moment, I think, for you listening is in the tech gainers, because they reveal what kind of tech is getting rewarded right now. It's very specific.
Okay, lay it out for us.
A look at Snap, SNAP, up nearly plus 18% after their Q3 earnings beat. And they specifically linked it to a Perplexity AI deal.
Tangible AI connection.
Tangible is the word. And then you have Datadog, DDOG. Also strong results, up over plus 15%. That really supports the story around enterprise software, cloud optimization, areas that are still seeing investment.
So let me connect the dots here.
Yeah.
What you're saying is the money isn't just chasing AI hype or promises anymore. It's flowing aggressively towards companies like Snap and Datadog that are showing real, actual monetization from AI tools. They're making money from it now.
Precisely. That's the critical distinction. And it stands in stark contrast to the sort of general anxiety you see at the index level, where you hear worries about AI valuation concerns resurfacing for the whole NASDAQ.
Right.
The market seems to be rotating, moving out of those broad tech bets the index plays and into these very select proven names that are actually delivering with the technology today. That's textbook idiosyncratic alpha right when the broader index is feeling constrained.
Okay, makes sense. But we have to look at the other side of the coin, too. The decliners. They often give us clear warnings about market sensitivity, don't they?
Absolutely. They're canaries in the coal mine.
Look at Celsius Holdings, CELH, down over 21%. That's a huge drop, especially since the results themselves weren't universally terrible, were they? So why such a harsh reaction?
CELH is a really crucial case study here. It highlights just how sensitive the market is to high yields and debt right now. The headline results almost didn't matter because investors immediately zoomed in on this, disclosed, what was it, a $247.7 million hit from termination costs, and it brought back concerns about their debt load.
So it's the balance sheet, not just the income statement.
Entirely. In this kind of high-yield environment, the market shows almost zero tolerance, extreme intolerance, really, for any kind of margin compression or any hint of balance sheet weakness. They're scrutinizing the cost structure intensely.
That hypersensitivity to cost and debt.
Yeah.
That sounds like it could easily spread, right? A contagion risk for other growth stocks.
It absolutely is. It poses a significant risk to any growth company carrying a lot of debt. If you've got thin operating margins and your borrowing costs are high, well, the market is going to punish you very quickly because capital just isn't cheap anymore.
Yeah.
We also saw this fragility, the skittishness underscored in biotech. Sangamo Therapeutics, SGMO, dropped nearly 24%. Why? A big miss on both EPS and revenue. It just shows how fast capital will flee clinical stage companies if there's any hint of failure risk. Sentiment is incredibly fragile there.
So it's a tricky environment then.
Right.
Very specific execution gets massively rewarded, but any slip up, especially on costs or debt, gets punished ruthlessly. Okay, let's pivot now to the macro forces that are really going to shape things today and later this week. The calendar looks packed with potential market movers. Systemic risk feels concentrated.
Yeah, the density on the forward calendar, it definitely suggests volatility is likely to spike. Just today, November 6th, we've got four high-impact Federal Reserve speakers on the docket, including Presidents Williams and Muslim.
And their timing is interesting, isn't it? Because we've had these really contradictory signals from the labor market lately. A decent ADP report on private jobs, but then that, quote, horrible layoff report showing 153,000 cuts.
That contradiction is exactly why their comments are so crucial today. ADP looks at payroll creation in the private sector, while the layoff numbers track immediate cuts.
So creation slowing while cuts are accelerating.
That seems to be the picture emerging, yeah. And it creates confusion about where the labor market is actually heading. So with all these Fed officials speaking today, there's a real amplified risk of what you might call dissonant messaging.
Meaning they might not all sing from the same hymn sheet.
Exactly. If they offer different interpretations of this conflicting data, the market's going to struggle to figure out the Fed's unified path forward. And that uncertainty, that usually translates directly into significant swings, intraday volatility, particularly in Treasury yields.
Okay, so watch the Fed speak closely today. Now looking ahead, later in the week, we get the real macro showdown, right? Growth versus inflation.
That's the main event the market is bracing for. We get the second estimate for Q3 GDP. Expectations are it'll confirm pretty solid growth, maybe even revised up slightly to 2.7%.
Strong growth.
But it's released at the same time as the PCE deflator. That's the Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation,
The one they watch most closely.
the one they watch most closely. So imagine the scenario. You get strong GDP confirmed, but it comes alongside a high PCE reading showing inflation is still sticky.
Uh-oh.
Yeah. That combination would basically pour fuel on the fire for the higher for longer interest rate narrative. If inflation stays hot, even with slowing job creation and strong growth, well, that would seriously worsen the existing weakness we're seeing in futures, the weakness driven by those yield concerns.
Got it. So a critical data pairing. Now, to get ready for that potential volatility, let's look at today's earnings watch list. These reports can act like real-time economic checks, can't they?
They absolutely can. Key insights today.
Which ones stand out for signaling broader economic health?
I'd keep a close eye on semiconductors, but specifically those with diversified exposure outside of just pure data center AI. We've got Qualcomm, QCOM, and onsemi reporting. They'll give us a read on chip demand in areas like automotive and industrial sectors. If they post strong results, it could actually provide a strategic counterweight to that generalized AI valuation anxiety we talked about earlier, show that tech growth isn't just about AI data centers.
Okay, diversified tech health. And what about the consumer? Given everything we've said about record debt, how do we gauge their pulse today?
Starbucks, SBUX, their earnings are crucial. Why? Because they provide really immediate, high-frequency data points on discretionary consumer spending. Coffee is a daily habit for many, but still discretionary.
A direct line into wallets.
Pretty much. It acts as a critical leading indicator, tells us how burdened or maybe resilient consumers are feeling with that record debt and higher rates. If Starbucks misses expectations, that strongly reinforces the market's deepest fears about consumer financial strain. And that fear, that contagion, could spread very quickly to other consumer stocks.
Wow, okay. We've covered a huge amount of ground here, from specific AI winners like Snap and Datadog to the extreme sensitivity around margins and debt shown by CELH, and now these big concentrated macro risks on the calendar. But for you, the listener, trying to navigate this, what's the single most important strategic pivot you need to be thinking about right now?
I think the absolute mandate is to pivot away from just passive index betting. You need to focus on proven, specific company narratives. So, strategically, think about overweighting those proven AI adopters, the ones actually monetizing now, like Datadog, like Snap. And conversely, you really have to consider underweighting companies with high leverage, growth stocks carrying a lot of debt, and those discretionary consumer names. They're just too sensitive to rising debt costs and margin pressures in this environment.
That makes sense. Be selective. Now, since rising bond yields, that yield risk seems to be the central constraint, the main driver of this broad market volatility. What's the primary hedge recommendation? How do you protect against that?
Given that yield risk is front and center, yeah, you absolutely need to hedge against the possibility of more hawkish Fed speak today or a high PCE number later this week. The primary macro hedge, in my view, should involve some kind of inverse exposure to long-dated U.S. Treasuries.
Okay, how?
Well, you could look at buying put options on an ETF like TLT, which tracks the 20-year plus Treasury bond market, or use similar inverse products. The goal is to protect your portfolio against that rising cost of capital, which is exactly what we'd expect if we get a hawkish outcome from the Fed or the data.
Right. Hedging the core risk.
Yeah.
That really crystallizes the picture. This heavy macroeconomic gravity is pulling the market down, but it's being selectively overcome, but only by superior company execution, especially those successful AI or strategic monetization stories.
That is precisely the tension defining the market today. It's a real tug of war. And maybe here's a final thought for you to chew on as you watch the data unfold. Keep an eye on the upcoming advanced durable goods orders. If that data confirms a genuine rise in business investment, specifically in things like automation and technology,
Right.
that actually reinforces the productivity story for companies like Datadog we mentioned. It suggests maybe, just maybe, economic growth could be driven more by these efficiency gains, by technology, rather than just widespread hiring.
So productivity up, but maybe not wages.
Potentially. It could suppress expectations for future average wage growth, even if the headline GDP number stays strong. Something to think about.
A profound thought, indeed. Productivity gains versus paycheck growth. That certainly adds another layer to this complex market. Thank you so much for guiding us through this really insightful deep dive into the forces driving capital flows today. And for you listening, we really encourage you to continue your own deep dive into these reports and analyses. Thanks for joining us.